Hello everyone, today is August 31st and this is our first session of the Wyckoff Trading course, the practicum. Why do we call this the practicum? Well, because if WTC1 course is all about the knowledge, the WTC2 course is all about skill building. And this is the sequence that we have here at Wyckoff Analytics. We truly believe that, and that's kind of like a very strong belief of mine, that knowledge is not the skill. You definitely need to get the knowledge. I see a lot in students that in a lot of cases, students just kind of withdraw by going and chasing a lot of knowledge, which is not necessary for being profitable. And you should kind of, consider some of the reasons of why you do that. The main goal in trading is just to make money. In order for you to make money, you need to understand how to make money. You need to develop the skill, because if you don't have this skill, you will not be able to recognize what you know on the chart. And yes, you need to build the skill just to do that. And then also, you definitely need to come to some kind of emotional comfort zone to execute your strategy. And there are some certain other things beyond that, like, we talk about the process. That's the next more advanced step. And we talk about, the mindset. And this is a step even beyond the process and so on and so forth. But this is not the class for this. Today, we're going to practice. And let me see, what is Nancy saying? Today is the last day of the payment plan at $249.50 per month for installments. Tomorrow it will be at $333 for 3 months. So for those of you who would like to sign up and you guys would like to use our recurring payments here, actually this is 4 installments, so 4 instead of 3. Then rather do this today. If you want to have 4, if you want to have 3, you can do this tomorrow as well. I've seen that there are quite a lot of alumni in this class, so which really pleases me. That just tells me that there is so much value in this offering that we have for you guys, that you keep coming back. I know that some of you are coming back not just for the second time, but just beyond. Franz, how many? What is this cycle for you going to be? Number 7, number 8, something like that. A lot of the alumni just come back. Why? Because you need to practice. And I don't know even how else to reiterate this. So hopefully throughout the whole session, that will be evident. And for those of you who are alumni and you're listening to me right now, $700 for the whole semester. For those of you who are new students, or you're going to sign up, $998, or payment plan payments. As usual, the homeworks, make sure that you submit those in the correct format. So I want your first name, the first letter of your last name, the class, and then the homework number. Just because we have quite a few emails coming to us, and to sort all of them through, it would be more efficient if you would do this correctly. And I will correct you again in the second class if something is wrong with the title of the email. Email us to wyckoff@gmail.com. Whatever questions you have, whether you have an administrative question for Nancy or you have questions for me on the content about the class, we'll be gladly waiting for your emails. This is going to be an interactive class as usual. And there is actually even more interaction, I would say, with the students in this class than in WTC1. So please make sure that you have a built-in microphone with the headset. And then all of the recordings and slides from this session, from this course, will be available to paid students. This particular session will be available to our guests. So today is an open door class. We have the students who already signed up. We have people who are thinking about signing up today, tomorrow, and then we have guests, and you guys are welcome. Okay, as usual, everything that we discuss in these classes is for educational purposes only, so stop the recording and read the disclaimer in full. Let's talk about the curriculum for this semester, and as usual, it's kind of the same agenda, but we definitely improve each semester on the content. So for those of you who are alumni, it's going to feel somewhat the same in terms of the structure, but definitely the content is going to be somewhat different. Well, we practice. That's why it's the practicum. So we need to apply our knowledge that we've got from WTC1 course to WTC2 exercises. So we're going to have a lot of drills and exercises during the class, and also your homework. Your homework is going to consist of 2 or 3 exercises where you will have to look at the chart. You will have to make your bias determination. You will have to show some of your trades and so on and so forth. And we will be discussing all of this material in the next class to make sure that there is a feedback as we look at your work. Some of the focus is going to be, as usual, on bias and timing, but I definitely extend this also to the character of how the price moves. So that's going to be really important. We'll talk a lot about the tactics and management, trade management. So developing different scenarios as to what might happen, and then we'll talk about, how could we actually use this to our advantage? How could we manage the trade? We'll talk a little bit about the risk management, although this class is not, specifically for that. We'll have some exercises on selection where we're filtering through the trade candidates. And then I'll give you some more advanced knowledge on Wyckoff method beyond of WTC1, of what you've learned in that course. And we'll talk about the phase behaviors, variations on price and volume signatures. We'll talk a lot about the trends, and specifically we'll discuss, the significant bar techniques, and those are proprietary things that I've introduced to my students a long time ago, like 10 years ago. So the last 3 or 4 semesters, we've been actively developing this material, and it's going to be great just to come back to start actually with that in the next class, and just to continue developing it to the next level. There's going to be quite a lot of historical examples. We'll have some modern TA tools discussions. Usually students bring their examples. So the discussion about any TA tools are going to be in the context of what is the Wyckoff concept there, and how could we use this particular TA tool in this context. So it's going to be interesting. Okay, today, what are we going to do today? Actually, this is slightly incorrect. So we're going through the introduction. We'll talk about the homeworks. We'll do the market update. As usual, each class will have that market update. I'm going to give you my view of what's happening. We'll do 2 exercises today, and this is not an updated slide. So let me kind of talk about this. Yeah, there are some mistakes that I see here. Exercise number 1 is going to be on observations and deductions. Then we're going to go into the review of the bias game, and that bias game is going to be a bias game 104. So I know that not all of you have done that, but for those of you who are alumni and been in the previous class, or you're just following us on Twitter or on our website, then I'm sure that some of you have done that bias game. So I'll show you an example of the discussion that we're going to have each class about the bias game. We are not going to do the anatomy of the trade, and instead we're going to do exercise number 2, which is going to be just a simulation. And the purpose of the class is just to show you, of this particular session, of this particular class, is to show you different type of exercises that we go through in each class, and for you just to get a sense of what we do in each class. Okay, so here's the homework. So for those of you who are students already, or for those of you who are going to sign up, or you're thinking about signing up, so please listen up. So we're going to have assignment number 1, a reading assignment. I want you to read 2 articles. The first one is actually the chapter out of the Outliers book by Malcolm Gladwell. It's called 10,000 Hours. And then the second one is called The Mundanity of Excellence. This is an article that was written in 1989 on the selection of the Olympic swimmers and what's the difference between the ones that are making the cut and the ones that are not. Please read those 2 articles. Not only they're very informative and instructive, they are also going to set up the intention for us for the whole semester. There is a specific way of how I want you to do our exercises. And that way is going to be outlined in both of the chapters. So we'll talk about that. And then obviously the bias game. So I would like you to go to our website, to go to our Twitter. The website is probably the easiest at this point. And then just to go through some of the bias games, either the ones that you haven't taken or the latest ones. So for those of you who have not done, let's say, some of the latest bias games, please do that. And starting from next week, we are relaunching the bias game on Twitter and here as well. So we'll do that. And then assignment number 3. So this is something new that we want to test this semester. Anatomy of the trade. This is where you guys are going to bring your own trades, and we'll try to figure out what are some of the issues, mistakes that are common in your trading. That will be done through the post analysis, and will involve fronts into that. And I'll talk more about how we are going to do that. But for now, just get prepared to show your trades at some point. So I would say that for next week, this is the key, just reading these 2 articles. And then if you are not familiar with the bias game, or you haven't done so in the past, please go to our website and find the bias games and start playing around with those. Okay, also a very common question for those of you who are guests in this class. I am recording this session right now. We will be posting this session on Wyckoff Trading Method YouTube channel. You will be able to watch it tonight, probably after 8 p.m. Pacific. And then for those of you who are students, as usual, the access information to the class page, which is behind the password wall, will be sent out also around 8 p.m. Pacific tonight. All right, let's do the market update. Okay, so a very simple statement is that let's say, looking at the leadership Nasdaq, the long-term trend since 2009 is up. The intermediate-term trend since COVID low is up. The short-term trend since the May low is up. There is really nothing distributional in nature. So if you are kind of like a perpetual bear and you always find the signs, of why you should be bearish, I would like to point your attention that the change from uptrend, let's say, to some kind of environment where that precedes the downtrend should take place with the deterioration of the price or the result to the upside, and plus increased effort to the downside. So that's basically, theoretically, the key to figuring out whether we are changing the environment, let's say, from the uptrend to a possible distribution and then to the downtrend. We don't see that yet. The price is still making higher highs, higher lows. The latest trading range is pretty flat, and it is contained in the upper part of the latest rally. Both are bullish signs. The result to the downside is somewhat limited in all of the instances when the price wanted to go down. So therefore, the latest trading range would be considered a reaccumulation. When supply occurs, even in these spots right here, where we see the volume signature going up and the price is going down, meaning that supply is present and there is some selling. The selling is somewhat limited within the confines of just an uptrend. And this whole uptrend that has started since the COVID low, right now, in my opinion, is in the third stage. And I think the bears have the case, which might come in the near future, where we might have some kind of top information, but we will have to see. So the first stage is right here of the COVID low, this advance right here. The texture of it is the same, right? So even the volume signature is somewhat homogeneous throughout the whole uptrend, upswing. And we're seeing that the reactions are of the same quality. We're seeing that the upspread is of the same quality. We see that the volume is of the same quality. And we see how the momentum signature is also the same throughout this upswing. And usually, I would call this a momentum takeoff type of rally of extreme oversold condition. So this is a very typical behavior. You can go back to 2008, 2009 low, and kind of like the recovery is going to have the same type of structure. The accumulation range will have the same lower highs, lower lows. The only difference is that everything in COVID is so much faster. Then we are going into the second stage, which I believe has ended right here. And in the second stage, we usually start having some profit taken by institutions. Why would that be taking place? Well, in the first stage of the advance, we have a lot of institutions that are trying to get into the position. On the way down, during COVID decline, a lot of them just capitulated and they sold off a lot of their shares. So what was happening here is that a lot of hedge fund managers came to this low being overexposed in cash, which they rightfully should be at that point. And once they have cash, they start investing, but they starting to invest gradually, not right away. They are launching some probes. They are launching some probes into stocks that they think that are much safer in that environment. And that's why we've seen off the COVID low, a flight to quality, a flight to safety, to the big stocks, mega cap stocks like Apple, Nvidia, Facebook, those type of stocks. And then as we go further into the trend, and we, institutional traders are seeing that the trend is starting to emerge and starting to show signs of sustainability, then they start to invest more and more and more and more. And that kind of develops the stride, the momentum, the sustainability of the uptrend. And as that also moves the price pretty quickly. And especially, again, during COVID, everything is so ultra fast. So when we come to certain spots after the first stage, there is some profit taken. And profit taken produces some kind of rotation where from, let's say, technology stocks, from growth stocks, we are transitioning into value stocks, which were still oversold in some of the cases at that point of time. So here's this rotation that is happening. And we also would say that with that profit taken and with the rotation, there are characteristics of the absorption that we could see, where, let's say, supply is emerging, increasing, somebody's selling, but also somebody's buying. And somebody's willing to buy and hold on to those technology stocks for some, let's say, time horizon that is beyond just the regular retail trader. So obviously those are institutional traders, and they they make their commitments based on the usually business cycle. So we would call this, just because the price is still going up, a vertical absorption. And that's our second stage. And then the third stage is basically a speculation. In this third stage, supply is controlled by very strong hands, and usually the price starts to accelerate and starts to create the new upward stride. We also would not necessarily see a lot of volume signature there, just because supply is contained. And even by this volume signature, you kind of could see different phases, different stages of this uptrend, right? So third, second stage, first stage. Okay, so far, nothing distributional. I mean, we would really have to break all of these support levels, break the trend line, create some kind of causality behind selling, because, you know, unless we have another instance of COVID or something similar, then the distribution could be on the way down. If we are just going through the rotation, then usually that type of the distributions would take some time, would develop some kind of price structure, and it would be more visible to us at some point than not. So far so good, still up. What else is interesting about the market? So I think Russell is still very interesting in the sense of how small caps were basically treated badly during this time since February rotation, and they most definitely underperformed. And I think it's all related to Delta COVID variant, where you know, that influences small businesses. But lately, we have had these two reactions, and these two reactions are somewhat similar, but there are some distinctions. So let's just go through those. First of all, the distance of these reactions. Let's say distance of the second reaction over the distance of the first reaction is diminishing. So we could say that the downward result in the second case is diminishing than the downward result in the first case. Secondly, the nature, or rather the texture of the reaction has changed. Look at the downward spread. So all of the spread in red. And we could see that the average downward spread in the second reaction is slightly lower. That decrease in the spread suggests that volatility also is diminishing. Also, when looking at the volume signature effort, we're seeing that volume is going down. So therefore, we would be assuming that selling is going down or supply is going down. And therefore, a downward effort is also diminishing. That's also a bullish sign. And we are structurally making a higher low. So even just on that, we could conclude that the reaction, the second reaction especially, and the first one as well, were of the bullish character, despite that the price was going down. It's going to be very evident and important for us to practice this type of situations where we are in the overall, let's say, bullish bias with the short-term bearish bias. And this is where a lot of novice traders are having some problems. A very common question to me is usually, well, I'm thinking that the long-term bias is this, and then the short-term bias is this, and I cannot kind of comprehend what to do and how to go about this. So we'll definitely talk a lot about that and how to deal with that. Secondly, all of the takeoffs just recently in Russell have some characteristics of the momentum, where we see the upward spread is increasing, and especially lately, especially on this big significant bar, we see the commitment above the intermediate high, which is a confirmation of the bullish behavior. So I would be thinking that our target is the cluster zone that was created by the highs in previous phases, and we most likely gonna overcome it. And if that happens on the continuation of the leadership by Nasdaq, with S&P also uptrending and the Dow confirming, the Russell will get there as well. So we just have to kind of like see how the price will go through this resistance cluster. We'll make some judgments on the character as how the price commits to the upside, and we'll just go from there. For now, the most important bar is this, and then after that, this too. Okay, let's look at something else. What else is interesting? Okay, well, gold, and we have quite a few students that actually trade gold, so there are usually quite a lot of questions. I would be saying that we're just in this trading range right here. And look at the volatility of this range, and look at the previous volatility. So it's not like volatility is gone. So as volatility remains high, we're still thinking that this is a trading range, because a function of the volatility usually is going to be related either to the downtrend or to a trading range. So in this case, we're not necessarily downtrending after this low right here. We are more consolidating. What do we do as a strategy in the trading range? We oscillate trades, right? So we want to come in at the points on the edges of the support and the resistance. And even if we have not, let's say, caught this type of tops and bottoms, then anything of this sort where we have some kind of upthrust action, failure, and then continuation to the downside, this is a V recovery, so you could definitely trade that as well. I would just swing trade that. And the second advice here is, if you're in the long-term campaign position like myself, I have a position in gold since 2019. I'm still holding this. I don't even look, at the P&L on it. It's in the IRA account. Just like it doesn't bother me that there is so much volatility. This is more for the long term. So you just have to hold on to it and have some kind of idea about the catastrophic stop loss where you would be getting out no matter what. For the short-term traders, which are swing and intraday traders, this is probably the best environment. Why? Because you have a lot of volatility, and intraday traders and short-term swing traders obviously, benefit from this type of volatile environment. Okay, let's talk about the beast, the Bitcoin. So we've called a couple of sprints here. I actually have the position at both of the spots on both of the days. I'm still holding this, and again, like with gold, this is a long-term position. Even if the price is gonna go down short-term, I absolutely don't even gonna blink or even look at the account. I doubt that the price will come back to the support level. I think the key here is just the short-term kind of like loss of the upward momentum that we're seeing right now. But every reaction that we have had has this bullish character. The latest development right here, this range, on the intraday level has some selling. And we're seeing how, just ever slightly higher supply is coming in. But what does it produce? Is this an aggressive deterioration of price? Probably not, right? Even though we have some bars that are expanding to the downside, it's still not that threatening. And the volume signature confirms that idea that there is not a lot of threat to the price structure right now. I think that there is a possibility for us, and I tweeted this the other day, I think yesterday, for us to go and to create either a sprint below 46,000, something like this, or let's say below 44, so go even lower and then recover from there. So what would that do? That would increase the supply from weekends, from somebody who's taking profits, and that will push the demand to come in and to start absorption at this higher level. And as absorption at the higher level happens, then the price stabilizes and usually recovers. And this is what I would be thinking if this were to happen. And this type of mini sprints, mini shakeout possibilities are actually healthy. When you think about the uptrend and how sustainability of the uptrend happens, you usually want supply to come in. You usually want supply to come in and immediately to be absorbed by the demand. And that's a sign of sustainability of an uptrend. Okay, what else is interesting here? Okay, so I was showing this to WTC1 students, and hopefully tomorrow together with Bruce we'll discuss this a little bit more. This is the whole structure since 2017-18. So I'm thinking this way here, guys. Here is our original accumulation, and here is our major sign of strength. Here is our reaccumulation as a backup. And this whole thing here is countable. We can put a horizontal P&F counts on this. And the first count actually went, and let me just show you this because this is quite fascinating. Okay, let's look at this. So our conservative, most conservative count at the bottom right here, it goes to 31 to 46 area. And usually you're going to have with the percentage for the box size, this type of big spread between the minimum and maximum targets. And then the second target, I think, is the most valuable to us because it just basically suggests that we're going to continue to the upside. There are higher objectives and we're going to overcome 100,000 on Bitcoin. The super aggressive count is something that you kind of have to think about for a while because it gives you, quite an objective here at 1.4 million. Is it possible? I think so. I mean, if any asset could be able to do something like this, it would be Bitcoin or some kind of crypto asset. And when we talk about this type of objective of 1.4 million, we are obviously not talking about 1 month or 2 months or 6 months or 12 months. We are obviously talking a long-term campaign that could be sustainable for years, right? So maybe 2, 3, 5 years, I don't know. But we definitely have to still kind of be in awe of this type of counts, but still keep them in our minds. By the way, reaccumulation count right here at the most conservative count line is bringing us to over 400 as well. So there is a confirmation between these two counts, which usually is a really great indication that the price might potentially go at least to that level. My whole idea about the Bitcoin is such that even if we have some kind of reaction here, so let's say like this, we're still going to go to this target zone of 50 to 60,000, where we had quite a few significant bars that produced increased in effort and that produced also some kind of downward result that was increasing. So this is going to be the area of contention where we're going to try to overcome. So I think that maybe we're going to be in the trading range. And we stopped right at the lower part of that resistance. So it makes sense. Alistair is asking, how often are the PNF counts accurate? I've seen quite a few that are accurate. I can't give you like a specific accuracy number. But what I've also found in myself and especially in others, maybe somebody who is new to the PNF and specifically horizontal accounts, if you're not doing this by the guidelines, you most likely, it's going to be very inaccurate. But if you know how to do this and you using the guidelines, then most likely you're going to be much closer to the correct target zone. So just again, practice. That's what we usually advise. Okay, let's go back. Yeah, and Bitcoin seems to be, short-term weaker at this point. So again, I'm kind of like waiting to see where the price would go down. Would it create another opportunity for us to go in, maybe even to add to the position? So it's going to be interesting to see in the next day or so how that develops. Okay, what else? Let's look really quickly at oil. So a very steady uptrend right here, change of behavior, the rally that overextends above the resistance and suggests that the bias is bullish. But yet, with the diminishing upward spread, there is a suggestion that we're going to have some kind of reaction. Reaction comes, supply increases, and then decreases. And we're seeing that decrease of selling even in the price spread. So one of the exercises actually that we're going to go through is going to be on the relationship between the volume and price. I'm going to give you, different ways to think about the volume and price, and hopefully you guys will like that. But here we're seeing that volatility is diminishing on the second leg down, and supply is diminishing, selling is diminishing as well. We are sprinting below the intermediate lows, and then the recovery is quite successful. Within the first 3 days, we overcome quite a few bars to the downside, 1, 2, 3, 4, 5, maybe 6, and it took only 3 days, to overcome all of those 6 bars to the downside. And then subsequent test is still holding. We'll have to see whether we could, test at the lower level, let's say, come in somewhere here and be able to hold here so that we would have some kind of recovery. Or maybe there is almost immediate continuation, which I would favor a little bit more at this point. And this continuation would lead us to the previous resistance point and beyond. So from that point of view, I'm looking at the upsloping structure here with the potential spring to be confirmed or to fail. That's the key phrase for us in this class. And again, we're going to spend a lot of time during the exercises thinking about this type of concepts, and we're going to be practicing those. Okay, I think that's it for the market. Yeah. Okay, let's move on. And if you are interested in our market update, I know that some of you might say that, okay, well, maybe I don't want to take a class, especially, for WTC2, you have to have a prerequisite of WTC1. So consider other offerings that we have at wyckoffanalytics.com. One of them is the Wyckoff market discussion that I conduct with Bruce Frazier on the weekly basis each Wednesday at 3 p.m. Pacific. We discuss the market. We go through the selection process, starting from the sectors, going into groups, and then going to stocks. We discuss different assets like, not necessarily all of the cryptos, but we usually discuss Bitcoin, we usually discuss oil, we usually discuss gold, silver, 10-year yield, US dollar, any other major markets. And it's usually very, very lively discussion between us. I absolutely, love working with Bruce, and it's just always a pleasure, to have students participate in those classes as well. Check out this offering tomorrow. We're going to have a free webinar at 3 p.m. Pacific. If you can't catch that, go to our YouTube channel. You could catch that episode, tomorrow's episode, on YouTube, probably by Thursday morning. All right. So let's talk about issues that we all have. There are two major things that I've realized and I've seen so many times, and I obviously I'm starting with myself, and then as I've been teaching this material for the last 10 years, I definitely have had quite a lot of students going through our classes. So what do I see as the biggest fundamental mistakes? Not necessarily like, oh, a pattern mistake or anything of this sort, but kind of like a fundamental approach to analysis. The first one is that we as people are not set up to see a lot of data around us in a very comprehensive, sequential, and big data type of way. Let me give you an example. Think about the surrounding around you right now. Are you in the room? Is this your office? Is this some kind of other room? I mean, obviously you have a computer in front of you and you have many, many objects around your table, the computer, and yourself, right? You probably have been in this room many, many times. Actually, probably for years and years, you used that room. If I were to ask you to describe and to put the list of all of the things that are in this room that you're in right now, would you be able to do so? And I give you a guarantee that you will fail to notice and to write down the list with all of the items in this room. It's just that we don't pay attention to the surrounding. So the chart is kind of the same. When we look at the chart, we unconsciously go to the specific points of observation. Those could be related to, again and again, unconsciously or subconsciously, those could be related to the specific things that we have learned, either intentionally, right? So you could learn a pattern and then you see that, or we could refer to the previous experiences that we've had where there was some kind of emotional connection with the chart. For instance, you traded the chart and you produced a loss, and that created some kind of emotionality behind that particular trade. So you remember the chart with more details, with more accuracy, with more colors, so to say. So we really fail to observe a lot on the chart. So one of the intentions for this class as we go through the exercises is to increase your capacity to observe the chart correctly, to notice more patterns on the chart, to notice more data on the chart, and then to understand what's behind it. And when we start thinking about what's behind it, we usually go into our deductive reasoning. And in a lot of cases, I see that out of the incorrect observational skills, or observations, we kind of go into the incorrect deductions. And generally, I see that both observations and deductions are somewhat, done incorrectly, or there is something is missing. So the goal for all of the classes and all of the drills and the exercises that we're going to do in this class is to make sure that we are correctly observing and correctly deducing what is going on. And we definitely want to do this in a very objective way. We want to have multiple, increase our observations of the data points. We also want to systematize our observation and systematize our deductions, and we want to put the weight of evidence on the specific events. And that's our goal. That's what we want to develop on a very, very fundamental level. Okay, well, let's jump into our first exercise. This one is easy. And for some of you that are alumni, you've done this exercise, but I want you to be in that refreshed mind, the new exercise type of mind. So the first question that I'm going to be asking you is, what kind of observations could you make about this 3 bars, 3 price bars, and 3 volume bars? So here is our data set. And you can write it down, so please do so. Whatever comes to mind, let me know, and I'm going to be writing those down. So let's start working. What do you guys see in this data? What kind of observations could you extract? Second bar from Joe. Second bar, more effort, less result. Okay, well, we definitely want to put this into the deduction column, right, Joe? Because what are we saying here? We're saying that there is some kind of something is going on with the second bar, where we have, okay, bar number 2. We have increasing effort to push the price up, and we have decreasing result. By the way, Joe, bullish or bearish? Bearish, yes, short-term bearish. And that's a deduction. Okay, so let's go to observations. Okay, spread in the first bar is the highest from Shri. Okay, yes, so bar number 1, largest spread. Okay, this is an observation. We are not concluding anything from this observation yet. We will come back to that, and then we'll make some kind of deduction. Second bar supply is coming in, Mike is saying. Okay, well, how do we see this? Let's make it into the observation. So second bar volume is increasing. And because the spread is decreasing, we're making deduction that supply is increasing, and there is increased selling. Okay, great. Climactic action at the second bar from David. Okay. Climactic. And again, climactic, why? We should understand what it even means, the bar being climactic, right? So we usually would be talking about either expansion of the spread, which we had on bar number 1. We would be talking about the stopping action, which is bar number 2. Or we would be talking about some kind of climactic volume signature, which is bar number 2. Okay, and then again, what would be the deduction out of this? Deduction would be that we are stopping at least at bar number 2. Okay, what else? Test it above the first bar close. From Julian. Julian, what do you mean by that? Test it above the first bar close. So what are we testing here? On the tail of the second bar? Okay, let's come back to that. Exhaustion of demand. From David. On the second bar, maybe not the exhaustion of the demand. Maybe a presence of the supply that stops the price from going further up. I would describe it like this. With the exhaustion of the demand, we would see diminishing demand signature, and we don't see it here, at least yet. Third bar, supply reduced, and demand shows up also from Mike. Okay, so third bar, volume is going down, so selling is going down, demand is going down. So our conclusion here, our deduction, is that selling on bar number 3 is diminishing. Okay, demand is present in the second and the third bar. Most definitely, demand is present in the second and the third bar. Okay, so as it is also present in the first bar, right? Because, and by the way, let me see who is saying this. Alex, where do you think demand is the strongest, or what bar is demand kind of like, is this not just the strongest but the largest? The first one, yes. So we could say that bar number 1 has the highest demand, and we could combine it with an idea or observation about the next 2 bars after the demand bar. So let me ask you guys this question. If we're saying that bar number 1 has the highest demand signature and the highest demand result, upward result, was that result violated? Was that result overturned? Is there a commitment to the downside below the bar number 1 that has that demand? All of you are saying no. So we're going to say bar number 1 has the highest demand plus non-commitment to the downside. From this, just from this, what kind of conclusion, what kind of deduction could we have? What's the bias for this pattern? Is it bullish or is it bearish? And I want everybody to kind of stop and think a little bit. And we will be doing a lot of thinking in this class. And I'm going to be pushing you, with whether you're going to be active participant or more for the observer, to think. In a lot of cases, what I'm seeing is people don't think. They kind of more trading reactively. They analyzing more reactively. They see something, they connect that to some past patterns that they have seen. So the bias, as all of you are saying, by the way, is bullish. Okay, great. Let me see. You guys are really good. You put a lot of observations here. So let me just come back and see, and kind of read through this a little bit more. What else? Okay. First bar, good spread, good close, volume less than bar number 2. Second bar, higher effort but no result, no show. Third bar, lower volume. Third bar didn't reach the bottom of the first bar. Okay, let's talk about this. So third bar has a tail. Is this a demand tail or a supply tail for the third bar? Right here. Here is this tail. Demand tail or supply tail? Oh, I'm sorry. I don't see your replies. Okay. Demand tail. Okay. If this is a demand tail, does this confirm the bullish bias? Yes. Confirmation of bullish bias. Also, the extension of that tail. Look at how we are not closing, let's say below 75% of the spread. We're not closing at the half. I would say probably the half is right somewhere here, but we're definitely recovering nicely into the body of the third bar. We also could say that we have tested the lower levels of the first significant bar, and we have come almost to 1/2 of that bullish bar. So really good recovery right there. And this is the type of observations that we will be learning, to make as we analyze the chart and as we analyze, the bars and the swings. And more importantly, let's continue with this thought. Bar number 3 volume, we said, is diminishing. Therefore, both supply and demand is diminishing. So if demand is diminishing, but yet we have a demand tail and we have a downward non-commitment, what does it say to you in terms of the bias? That's number one, as a confirmation. Still bullish. And more importantly, what about the character of effort? This is the new terminology that I'm giving to those of you who are alumni. Character of effort, or character of demand. Is demand capable, let me rephrase this, is the lower demand, because we have a lower volume signature and therefore lower demand signature, is the low demand capable of pushing the price up? Yes. Okay, so lower demand could produce the upward result expansion. What does it mean for the supply? Supply is either weak, lower supply, diminishing. So all of you guys, supply is running low, lesser. All of you guys are correct. So I'm going to just put less. So less selling. If this is less selling, then are we ready to go up from here? I mean, obviously, if supply is less, then what would the price do? Yeah, the price would go up. So the timing element of it built into this analysis. Do you guys see that? Yeah, are you feeling it? Okay. I could go on, and by the way, you guys did a really good job. You put a lot of observations in there. And this is our job right here. This is such an example of how we should work with the chart and how we should work with the bars and with the swings and with the structures. We need to observe correctly. We need to understand what we need to observe. We need to observe that correctly in a very objective way. And then we need to make correct deductions. And usually you don't have to have numerous observation points and numerous deductions out of that. You could concentrate just on the specific sequence, which I will give you during this course. We will talk about the bias game, and we'll talk about how specifically are we going to go through determining what the bias is. There are two ways that our students are going through the bias. It's either going to be our bias sequence, and I'm not going to go through this right now, but in the second class we'll do this, or we're going to do the flashcard idea. The flashcard idea actually was developed in this class, in the practicum, where I asked students to define just one idea behind the bias, the most crucial idea. All right, but this is really good job, guys. I mean, like, look at how in the, and this is a bullish pattern, by the way, so that just to give you the answer to this, literally in what, 5-10 minutes, we were able to make so many observations, and we didn't even put all of them, everything that you wrote, I couldn't put on this page. And then we've done quite a few deductions. So that's exactly the way how we're going to work. Okay, let me see. There are some questions here. Okay, from Scott at the bottom of the trading range. Okay, so I think I missed that question. From Steve, ready to test the above the close of number 2. Yeah, we are basically going up from here. From Mohammed, what confuses me, bar number 2 has more volume, but price stays higher than bar number 3, where bar number 3 has lower volume with more spread and low volume. Okay, well, we probably could, and I'm going to erase all of this. This is a really good question. So I would be assuming that on the expansion of the spread, we have expansion of the demand right here. If we have the expansion of the demand, we have some kind of momentum, which is going to carry us more into bar number 2. So let's call this a bar number 2 extension. So therefore, bar number 2 is going to contain both demand and supply. Both are increasing. And demand is still relatively strong, but not as strong to create another close. So it's almost at the same level, slightly more. That probably tells us more about the supply rather than demand. We are seeing that demand is actually not the same as on bar number 1. And more importantly, we know now that supply is coming in just because volume is increasing. This means that supply is increasing, especially on the background of the diminishing upward result. Okay, so, and then what happens next? So there is some kind of battle that is going on between supply and demand on bar number 2. Supply is stopping or observing demand, and that stops the price movement. And then once it did so, what's going to happen with the price? As demand is no longer in control, the price is going to go down. As the price goes down, what happens with the supply? We know that supply is going down because the volume went down. If supply is going down, and we are saying that bar number 3 is non-threatening bar, was the result, then we know that whatever sell-in came on bar number 1 was the most of it. And bar number 3 sell-in has diminished. There is the uptrend, let's say, or any upswing is never just demand. It's always demand and supply. And then relationship between those two, and the relationship between the volume and the price. Supply will always occur in the uptrend. Supply will occur, produce temporary stopping action that will produce a reaction, but on the reaction, sell-in usually will subside or will be observed, and then the uptrend will resume its course. In a lot of cases, it is kind of surprising to, and Mohammed, I'm not talking about you, but just in general, surprising to encounter the thinking by students where some students are thinking, if this is an uptrend, then demand should be always in control. That's not true. Even during the downtrends, supply is not always in control, even though downtrends are usually fear-driven and they are much more aggressive and intense. Every trend will have both forces. Every trading range will have both forces, supply and demand. And what we are doing is we're looking at that relationship and the effect of that relationship on the price. So did supply occur on bar number 2? Yes. Temporarily, did it regain the control of the price? Yes. Going into bar number 3, is that control still there by the supply? No longer. Selling has diminished. Demand has come in, and at the lower demand signature, we are producing something to the upside in terms of the result. So that just tells us that the quality of the supply went down, selling diminished, and a lower quality demand is capable of pushing the price up, which suggests that we are done with selling. And right now, the price has a high probability of the short-term move to the upside, specifically to the resistance point of bar number 2. Mohammed, how's that for an answer? Did we cover that? And we could definitely talk more about this in the upcoming classes, and we will, for sure, because this is the correct question to ask. These are the type of questions that we want to cover, that I want to cover with you guys, and this is the exercises that I want us to have to go through something like this. Okay. Why couldn't this be interpreted as a neutral bias, as bulls and bears determine which is stronger? From Stephen. We can do so, right? We could, I would say that bar number 2 could have that type of thought and premise, Stephen. Why? Because there is some kind of equilibrium of the result. But we can't really say so about the overall pattern. Why? Because we have a very strong bar number 1 with strong demand and strong upward result. This defines the bias for us initially and kind of carries throughout the whole pattern. Because bar number 2, even though this is an equilibrium, basically a story about emergent supply, increase of the supply. So what does it do? It kind of suggests that we're going to have some kind of reaction. And from here, from this reaction, we go to bar number 3 to determine what is the outcome of this reaction. Is it bullish or bearish? That's the question for bar number 3. So what is it? And we went through those observations. We said the volume went down, so there is less selling. There is a demand tail, so that suggests some buying on lower demand, which is great. And there is non-commitment at the close relative to bar number 1. So that still looks bullish rather than bearish. So I would say that if there was some kind of equilibrium or neutral bias, it was probably still most likely at bar number 2. But even at bar number 2, we were still bullish overall, right? After a big demand bar number 1. Okay, so hopefully we've covered that. Francis saying, thinking about the duration of the bullish move depending on the time frame the bars represent. Thinking about the duration of the bullish move depending on the time frame the bars represent. Okay, Franz. Yeah, let's talk about this during next classes. I'll have to think about that. I'll have to think about this. Okay, well, let's jump to the next portion of exercise number 1. So here is, if we were covering just 3 bars, well, actually, there were quite a few data points. And by the way, when we started our observations, I kind of forgot each bar represents data points as well, right? Open, close, high, low, bias, the color, green or red, and then the volume signature. Volume signature could be, let's say expanding or declining, diminishing, volume signature, and levels. Then next, so this is kind of like a primary data for us. The next type of data is going to be, it's more of like observation. What is happening as with all of this primary data? What kind of deduction we could make, right? So that's kind of the sequence of logic that we are going through. But this is only 3 bars, 3 days, or 3 bars. How about this? So now instantly think about that analogy that I gave you about the room that you're sitting in right now. Can you recall, can you list all of the data points, the things that are surrounding you in this room? What color they, what size, what shape, is there anything written on those? Did you buy them yourself, or were they presented to you? I mean, like, there are so many data points. A chart is like that. We have so many bars. We have so many data points here. How do we actually go and concentrate on the specific price volume action? What is important to us? What should we be observing on the chart? And then how do we actually deduce, what, let's say, the bias or the timing is? So here is a chart right here. What kind of observations could we make here from this chart, guys? Write down your answers. Climactic selling volume, okay. Climactic. And by the way, right away, we're going to go into deductions, right? So if this is climactic, so this is a stop in action. So there is some kind of stop in action, climactic stop in action. Okay, what else? Climactic action followed by diminishing supply. Okay, yes, we see that supply is diminishing. And we also see in what, guys? With this diminishing supply? Shortening of the thrust, and then a higher low. Okay. Volatility decreasing after the selling climax. Okay, yes. So we can't go down as much right now. We the thrust, the downward thrust is shortening. Supply is diminishing, volume is diminishing. Okay. Tails. Okay, so like this tail right here, this tail right here, this tail right here, this tail right here. So what are those tails? Are those demand tails or are those supply tails? Definitely demand tails. Okay. First half has a horizontal range that breaks down. Okay. Yes. Look at that. So there was some kind of range. So we are defining the context of this very sharp move to the downside. Even this right here, this area right here, acts as a sign of weakness, and I would say like minus sign of weakness. And then lower high fails quickly to the downside, and I would say that this whole thing is probably some kind of sign of weakness that we're observing at this point. Okay, what else? I want to go to the right. So what observations about the right side of the chart do you see? After stopping action, subsequent higher highs, higher lows, recovering 50% of the sell-off. Okay, excellent. This comes from Steve. Okay, so recovery, 50% retracement, higher highs, higher lows, therefore an upward stride. of some kind, right? So we're somewhere here. Okay, what else? Spread continues to diminish. Which spread, Joe? Up spread or a down spread? Which spread is continuing to diminish? Downward spread, right? Okay, so let's just say that the downward spread is diminishing. Okay, so lots of reactions followed by advance in prices. Yeah, and we also want to note what kind of reactions do we have here, right? So this is going to be important as well. So for instance, this reaction right here into a higher low, this reaction into a higher low, this reaction, this reaction, this reaction. So these are the types of the reactions that we have in this mini uptrend right here. We will come back to this. I just want to point your attention to that. Second half cannot recover the previous support. So here is this support. Okay. So we are encountering some kind of resistance. Okay. What else? Okay, volume signature in general. Okay, well, volume signature is a little bit specific, and we'll talk about this later on. Okay, what else? Okay, so some of you already jump into the bias. I want to stop you. I don't want you to think about the bias right now. And in a lot of cases, this is kind of like where we are making the mistake. We are making specific observations, and then out of those observations, you pick something that you think is crucial for the bias, and you might be mistaken. Let's do this. Let's go through these observations one by one. Let's just say this. What is the long-term bias here? And by the long-term bias, I mean the whole chart. Is it bearish or bullish? Bearish, you say. Why is it bearish? Yes, lower highs, lower lows. That's just very much the definition of the downtrending environment. What about bearish behavior on the sign of weakness, that drop? Is this the most aggressive um, price action that we see on the chart? Most definitely, you say. Okay. Okay, Tarek, I'm talking about this price action right here. Yeah, so this is the most intense, right? So the most aggressive move to the downside. So from those two things, lower highs, lower lows, plus the aggression to the downside, that extends the gains to the downside quite significantly, right? So that's definitely bearish. So this just confirms the bearishness. Okay, how about this picture right here? This is a short-term trading range. So in this short-term trading range, we said we see demand tails, we see the climactic action, which is the stopping action. We see the shortening of the thrust. We see how volatility goes down. We see the higher highs, higher lows. We see the downward spread diminishing. Are those characteristics bearish or bullish? bullish, you say. And that would be also correct. So we are in this dilemma where we see that the long-term structure might be pointing down, whereas the short-term structure might be pointing up. This is very, very common, spot where a lot of mistakes could be made. Okay, let's just say that we are short-term traders here, that we are just trying to catch this swing. What will be, in your opinion, the next swing? Is it going to be to the upside or to the downside? Okay, a lot of you are saying to the upside. Why is that? Why do you think it's going to be to the upside? No follow through to the downside, Alex is saying. Because we're in a short-term uptrend, Mohammed is saying. No climactic supply yet. Up to test the resistance. Sign of strength, which is the short-term sign of strength, obviously. Touching the oversold support of the channel from Sergio. I mean this one, Sergio right here, oversold. Yeah, temporarily oversold. Yeah. So in short, we just don't have any evidence, short-term evidence, that supply is somewhat in control, right? So for instance, when we talked about the reactions, look at how aggressive this reaction is. Look at this reaction. Look at this reaction. Look at how this reaction becomes less so aggressive. What about this reaction? Is it aggressive? It's probably on par with what we've seen here. So these two reactions are less aggressive, suggesting that we still probably will go up and we'll retest something, right? So we'll retest what? We'll retest either the upward channel or something else. What are we really testing here with this rally that is so choppy? What is the most significant bar on this chart? The large selling bar, is saying. I would be assuming that this is the one right here. And this is the zone that we're testing. And we're already at the high right here. So could we have another test of this area? So far, we don't see that the supply is damaging short term. So most likely, this is the trade for us. And we could create the trade out of this, maybe like a high, overcoming the high of this small trading range, any type of breakout. I would be thinking that, this is target number one for us. And then maybe like 1/2 of this spread. This also could be a target number two. So any reversals right here in this area, most likely we would be out. So we would be thinking about the trade where we originated at this point, and then if reversal happens, then we are out. Why? Because the long-term bias for us is still down. We're just playing a short-term trade out of this. Okay, well, let's see what happens. Here's what happened. From here, this is the bar, and this would be the trade. We said that we want to capture the target zone like this. As the price starts to advance right here, bar by bar, right? So we see that there is a reaction that is upsloping reaction. This breakout suggests what over this high? look at the quality of the breakout and think about what it suggests. Continuation to the upside. Yes, so at least some kind of, short-term strength. We should be expecting continuation here. We are continuing. As we're continuing, momentum is decreasing. That's our data point. We see this from the spread. What does that mean? Selling is coming in. Well, not necessarily, right, Alistair? When momentum is decreasing, that's going to be a function of the demand. So demand is diminishing. And from there, we could come to the same conclusion that we could have some kind of reaction. Okay, reaction comes in. Is this a threatening reaction or non-threatening reaction? Non-threatening. We see this from the volume signature. It's very low, so there is no selling. And then the reaction comes to the breakout area. So in a way, it acts as a test. And then from here, we are expecting some kind of continuation. Continuation happens, and we create maybe a slightly lower high or the same type of high, and then we fail. So there is some kind of failure. What does it mean? Can we continue going up from here? That would be the question. We're failing. So combining all of the data points that we have here, we broke out, momentum started to decrease, suggesting that demand is decreasing, suggesting we're going to have a reaction. Reaction happens in non-threatening way, suggesting we're going to have another attempt to overcome this area where selling was intense. We come to this area, and right away the price is being rejected. The price commits to the downside. The supply slightly increases, and that is suggestive that we probably gonna retest again this area right here, which we do. We come back to this area, and here we are again. Let me ask you this question. The long-term bias on this chart is still bearish just based on this price action. We already know that this is the most important area for this chart. We have had one stop in action. We had another second stop in action. The reaction, the latest reaction, does it look like the reaction that is, again, threatening reaction? Change of character, Tarek is saying. Buyers are losing the battle, Francis is saying. Alex is saying non-threatening. I would probably be thinking that it's not that threatening so much, right? First of all, we're stopping just at the same level as we've had previously. That's number one. Whatever supply is coming in, it's coming in closer to the end. So there is some demand behind that as well. As the price goes down, the volume does not necessarily increase. Supply is kind of, stable. So, and here is again kind of like this dilemma. Long-term bias is still bearish for this particular chart, and short-term bias is still bullish. What do you think in this type of environment could we expect from here? Mohammed is saying neutral bias, need more proof. Yeah, we most definitely not in the trending environment, right? More trading range at this level, Francis is saying. I would say so. In conclusion of the overall price action, just based on the differences in the biases on different time frames, short-term bias and long-term bias. It seems like, yeah, there was a lot of aggression at the beginning of the chart, and then we are reversing that temporarily on a short-term basis, but the selling is still the original selling is still strong to the point where we have to consolidate at this point. So I would be thinking that we probably would have another attempt to go up. We're in some kind of consolidation formation, and we might end up, doing something like this and going through the trading range where we should define the proper bias. And that's the main conclusion from this chart. And in a lot of cases, we're going to fail to think this way. We're going to probably be more attracted to the charts where, we are either strictly in the uptrend or strictly in the downtrend. And obviously, these type of scenarios we should take advantage of. But if we're trading just one market, let's say like Nasdaq 100 futures, this is one minute chart. So right away, I know the question is going to be, why are you looking at 1 minute chart? I'm not looking at 1 minute chart. I'm looking at the structure with a lot of details. That's the big difference. The second question, why do you bring the example of the Nasdaq futures and not, let's say, a stock or crypto or anything else? Well, I was just trading it today, so it's kind of like wanted to talk about what's fresh. And look what happens next, right? So here's our observation points. Price stops at the same level. The selling bar is still in control. So every time we come to this level, we're going to experience some kind of resistance. So therefore, if this is a trading range, we are oscillating trades around these levels. And that was today's day. But behind this, if we would go through all of this logic correctly and deductions correctly, we would be thinking that for today's session, our trade opportunity most likely was where? I'd say that probably somewhere in this area right here, somewhere in this area right here, somewhere in this area right here. They were all to the upside. And I would say that somewhere here, we had an opportunity to go to the downside. So through the observations and deductions based on our understanding of how the price and volume interact with each other, we would have this type of trades today. And this was an extremely difficult day because, first of all, the daily spread did not give us a lot of room to operate. That's number one. And it was non-trending day. So it was a very, very challenging day, to say at least. But still, we could make something out of it. We could either choose not to trade it at all, or if we are trading it, that would be the logic. That would to the analysis and to trade execution. Okay. Any questions from Alistair? What do you make of the high volume near the close? Would that be considered a bullish end of the day? Well, first of all, because this is futures, then the volume signature is going to be, like this. Every session has the largest volume signature at the beginning. Then during the lunch hours, we have the volume diminish a lot. And then into the end, where there is some commitment of the traders, we usually would have institutions committing at the end of the session at the close. I would say that today's session was basically emergence of the supply, and then what initially supply has produced, and then test, 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 and test. How's the test holding? Is it holding well? I probably would say so. Yeah, so it's kind of like it's working through the supply. It might fail, during the Asian session and European session, But so far during the US session, whatever supply came in, it was observed, and then we're holding, and we're holding, and we're holding. So for now, when we look at the longer term picture, we're still up. So this temporary emergence of the supply and then the test is suggestive that we still are going up, and supply is capable of temporary shakeouts, temporary reactions. But yet the demand is capable of overcoming this and closing somewhat positively, somewhat, bullish in a sense of where we've started for the session, and yet we've come back to it. So I would say that today's day was, even though to the downside, was somewhat bullish and confirming the overall daily trend. Okay, so we're almost at 440. Okay, great. Let's switch gears. So this was exercise number 1. Now let's go to exercise number 2, something that we will be doing in this class each time when we get together. First of all, I want to bring your attention, for those of you who don't know, that our bias game is being played out on Twitter, our handle at Wyckoff Analytics. We usually would post the assignment slide. That's step number 1. And under the assignment slide, you will be able to cast your votes, whether you think this is an accumulation or a distribution. You could also see what community is thinking, what the bias is, which is pretty cool, I think. And then a couple of days after, we will tweet a solution with our own labeling, with our bullet points on the chart, and with our Wyckoff story. This is an educational tool for you guys, and even for some of you who are not going to take this class or WTC1 class, you guys could totally play this game with us on Twitter, completely free, or on our website, and learn. And even ask questions sometimes. Sometimes I would answer the questions to the bias game on Twitter. If you want this to become a more systematic exercise for yourself, where you practice each day or each week, go to our website, wyckoffanalytics.com, and find the bias game there, which is, again, completely free. We have 104 bias games so far. Start with number 1, or start with number 104, or whatever game you want to start with. Print out the assignment slide, solve it first, then go to the solution. Print that out too, read it, make sure you understand where you made a mistake, if you did, regardless whether you answered correctly or incorrectly. Post-analyze your chart, compare it to ours, and learn that way. If you're gonna do this for, let's say, several years, each week, your trading will improve. Or maybe not even the trading that will improve, but the analysis will improve for sure. I mean, when people come to our universe and they ask me, well, if I take your course, can you guarantee that I'm gonna make money after that, after the course? And my answer to that is no. I don't know how much time you're gonna spend on the course. I don't know how much of the commitment you have at this point. I mean, you really, really have to spend time on this, working hard, going through all of these charts, solving all of those puzzles, going through the exercises, acquiring the knowledge, applying it multiple times through the repetition. If you promise to me that you're going to do all of that, I'm going to tell you that yes, you're most definitely going to improve your trading, and you will most definitely will improve your analysis, because trading and analysis are two different things. So take this, into the account when you, tomorrow, let's say, start thinking about, how could I improve my trading. At least do that, and if you want to do more, come to our classes, and specifically this class, the practicum class. And during the class, we are discussing the bias game, starting with the assignment slide. So here is our assignment slide. Please don't go to our website and don't look at the solution. Do yourself a favor. And this is the bias game, guys, for those of you who are alumni that we have not discussed. So please say yes if you have done these bias games. Let me just see if you guys have done it. Yes. Okay. Some are saying no. All right. Okay, so majority of you are saying yes. So why don't we do this? For those of you who said yes, if you remember, what was the biggest challenge with this chart? Mohammed is saying, can you define the alumni? So alumni is usually the students who have taken this class, so meaning the practicum. Do you guys remember what was the challenge? Okay. Maybe we should just start from the beginning, as you're saying. Yeah, okay. So we've got a trading range right here, right? Here's our trading range. How do we go about defining the bias? What would be the first thing that we would do? Do you guys recall? What is the previous trend? Francis is saying, yeah. What is the previous trend? We don't have it here. We're just in the trading range environment. So that's the trend, non-trend. Okay, so what's the next thing that we would do? A lot of you are saying labeling. Labeling will be done last. And that's kind of a huge mistake that took some time even for me personally to overcome. We usually start thinking about labeling right away because we Wyckoffans always would like to label the trading range. But in reality, how could you label the trading range if you still have not defined the bias? Think about this for a second. How can you label the trading range if you don't know the bias of this trading range? Does that make sense, guys? You need to define the bias first in order for you to start labeling. You might start labeling some elements of the trading range, recognizing some events. For instance, this event right here, what is it? How would we label that? Selling climax. Correct. Okay, if this is a selling climax, then what is this? Secondary test. Correct. If we are overcoming some points of the resistance, what is that? Upthrust. We don't know whether this is an upthrust action, which is bullish, or just an upthrust, which is bearish. So I'm going to put it like this, upthrust or upthrust action. Okay. And then what is this event right here? Okay. spring, major sign of weakness, possible spring, spring, major sign of weakness, shakeout, potential spring, 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 sign of weakness, selling climax, shakeout, shakeout. These are your answers. At this point, we would say that this is either a spring or a sign of weakness. So you could label it like this. Yeah, I mean, that I don't have any problems with. But at some point, you have to decide whether this was a spring or a sign of weakness, whether that was an upthrust or an upthrust action, whether this is a bullish bias or a bearish bias. So let's start with that. Let's define the bias first. And to define the bias, I think Franz and some of you also said that let's look at the spread and swing analysis, right? So let's look at the swing analysis. So we have, let's say, let's start with the reactions. Actually, let's start with the, rallies. Okay, so rallies. We don't have a lot of rallies here, so let's just start with that. After the sell-in climax, do we have a really good rally? Yes, you say. Okay, so why do we have good rallies? I'm sorry, not rallies, one rally. Okay, Joe is saying the rally, so let's label the rally in red, 1 and 2. Rally number 1, Joe is saying, is retracing the past swing down, the latest swing down. So rally number 1, full retracement, plus we are creating some kind of upthrust action or upthrust. Okay. What else do we see on those rallies? Higher highs, higher lows. Well, rallies are gonna be a reef like that, right? So higher highs, higher lows for sure. Okay. So what else? Spread. Tree is saying spread. What about spread? Upward spread is doing what? Upward spread is increasing. Yes. Look at this, right? Here, 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 here. Okay. So what else could we say about this rally? Okay, selling exhausted temporarily on rallies that will be France. Momentum, yeah, we have some kind of pickup in the momentum. What else? Volume increase with the rallies. Yes, look at the increase in the volume. So here, volume is increasing. Does it mean that the demand is increasing as well? Yes. Volume is increasing, means demand is increasing. Volume is increasing, demand is increasing. Okay. And let's kind of stop here. So full retracement, bullish or bearish? Bullish. Upthrust, ability to overcome the resistance, bullish or bearish? Bullish. Increase of the upward spread, bullish or bearish? Bullish. Increase of the upward momentum, bullish or bearish? Bullish. Increase of the volume as the rally travels up, meaning increase in the demand, bullish or bearish? Bullish. Okay, so far, what is the bias after this rally? Bullish. Okay, we're not done. Why don't we jump to the reaction right now, right away? Just we'll go in sequence. Reaction number 1, reaction number 2, reaction number 3. When we would compare reaction number 2 to reaction number 1. What could we say about the character of the reaction number 2? Is it more bullish or more bearish? Don't answer that question. This was, for now, just rhetorical question. Let's make some observations first. And this is where I want you to kind of think why I'm so strict by not allowing you to think about, whether it's bullish or bearish. I just want kind of like have that question in your mind. The first sequence that we do is still we need to observe correctly what's going on, then make deductions, and then say what the bias is. Okay, so let's go through this. Decreasing spread, Shri is saying, I would be thinking that you're talking about the downward spread. So the downward spread is diminishing. What else? Volume is declining. Okay. Does it mean that supply is declining as well? Yes. Okay. 3. Speed of the movement downward is less from Joe. Yeah, we could say that the shortening of the thrust is happening. The shortening of the thrust usually will indicate to us that velocity is diminishing as well. Okay. What else? 1 moves quickly down with few attempts. Yeah, so I mean, like if we would deconstruct this downswing fronts, I think that's what we were saying. We would say that this was where the selling was the most intense, and then selling just deteriorates throughout the rest of that move. Okay. Steve is confirming that decreased aggression to the downside. Okay, great. Yeah, decreasing momentum. We could say decreasing momentum free. Yes. Demand tails all the way. Yeah, there are some demand tails here, usually at the stopping spots, right? So this is where the price stops. Okay. High or low, Wendy is saying. Yes, relative to the climactic action, it is a high or low, which is also structurally very important. Okay, so let's go through this. Downward spread is diminishing, bullish or bearish? Bullish. Volume is diminishing, supply is diminishing. Bullish or bearish? Bullish. Shortening of the thrust and velocity is falling down as the price goes down. Bullish or bearish? Bullish. Selling generally goes down. Bullish or bearish? Definitely bullish. And then a high or low relative to the climactic action. Bullish or bearish? Bullish. So we kind of see the sequence now after the aggression into the stopping action at the selling climax. The rally is really bullish, and then the followed reaction after that is bullish too. So far, the bias is bullish. The key to this bias game is in the last price volume action. So let's deal with that. Here's our trading range. Next rally, which is rally number 2. Do we have, do we cover the same distance as number 1? No. So the distance of the swing is diminishing on rally number 2. What does this suggest? What deduction could we make from here? Some kind of weakness, right? Reaction might come. So possible reaction. Okay, so what else? We are seeing that the volume signature is still increasing on this rally. So demand is increasing. What does it mean? Is this a bullish action or is this a bearish action? it's still bullish. We're seeing that there is still some buying after a weak reaction. So still bullish. So we are in this kind of like mixed bag picture where the rally is still suggesting that buying is going on, but there is some kind of short-term weakness that suggests a possible reaction. When that reaction comes, and this is going to be the key right now, reaction number 3. What are we observing here? Weak breakdown to the downside plus no downside follow through from Alex. Okay, well, right away we almost like go to the deductions here. Okay, what is the commitment to the downside on this reaction? This is the extension of the commitment into the close, into the lowest close. So that's the most that we can do with this type of the aggression, right? The next bar has some demand behind it. So 1 bar commitment, down commitment. Okay, 1 bar down commitment. There is no progressive closes beyond that bar to the downside. I just want you to kind of like see that because it's very important. If we would take this bar out, I mean, like there are no other bars that are as threatening as that bar. There are no other bars that have, closes that are progressively going down, which is very important, for the sign of weakness. We also said that there is no downward follow through. Why is this important? Well, because if you have a sell-in, it should persist. If you have a sell-in, demand should be weak. And yet, what happens on this bar right here, the lowest bar? We definitely see the demand tail and demand aggressively coming in and lifting the price almost immediately. After this demand is coming in, do we have some kind of failure? We don't. We're actually going up. And on this bar right here, supply is coming in, and yet what do? Do we have some kind of follow through to the downside? No, we don't. Shri is asking, is this a second point of fear in phase C? Well, it looks like it. So just based on the result and on the recovery. So here is the key. Basically, we said that this is either a sign of weakness or this is a spring. And we need to understand the definition and the looks of the sign of weakness in the spring. The sign of weakness is going to have that very extensive penetration below the support, right? So where we could have what I'm calling progressive closes down, right? What are the progressive closes down? Something like this, where we have first close down, second close down, third close down, where we have a substantial overextension below the support. And then subsequent rally comes to the resistance and kind of starts to fail. And we're seeing that all of the elements of the demand cannot lift the price above the resistance that acted before as the support. In a sprint situation, we usually will have a temporary commitment to the downside. We would have something like this, where we quickly would recover back. Temporary commitment, recovery. Sign of weakness, sell in, Selling continues. Rally is weak. That's exactly what is happening here. We are temporarily committing and then quickly recover back. So you could have solved this bias game just looking either at the latest reaction and how it recovers and how demand is coming in. And that would be a solution on its own, a flashcard solution right there. Or you could have gone through the trading range like we did, discussing first the reactions or reaction and then the rally that follows, and just observing what the bias is. We could start with the downward bias, downtrend. After the selling climax, we would say, well, this is a pretty good rally, so the bias is changing to the bullish bias. The next reaction confirms the bullish bias. The next rally confirms the bullish bias, but suggests some kind of reaction. Reaction shows temporary commitment to the downside and immediate recovery. Bullish bias, potential phase C, spring. And that's the solution. So this was Cardano. Majority on Twitter said distribution. So that was very interesting. Most definitely, that was somewhat of a difficult test. I think that our minds usually go to something dramatic, something like this. This is very dramatic. And we can't contextualize this just because of its dramatic look. But if we would contextualize what came before that or what comes afterwards, if we would just take this picture is really bullish. And then what comes afterwards? So I've given you guys, obviously, a challenging afterwards scenario where I'm stopping the chart somewhere here. Would you go a little bit further, like somewhere here in this area, you would most likely say this looks very, very bullish, right? Because the recovery is already not only into the body of this selling bar, capitulation bar, but also into one half of the trading range. But I'm not giving you enough data on purpose because there is enough data in the context of this whole chart to define the bullish bias. It's intentional. I'm challenging you. I'm challenging you to see beyond of what you're seeing right now and stretching your minds to see what you're not seeing yet. You're looking at it, but you're not necessarily seeing it. So this class is all about that. Seeing something that you have not seen before on the chart, on the same chart that you looked before, and making some kind of deductions that you have not made before. So for those of you who are still thinking, should I take this class or not? That's what it's all about. Okay, would you say that this continuation right here is also bullish? Most likely. Looks very bullish. Recovery into the trading range, recovery into the capitulation bar, sign of strength, last point of support. So then, what is the problem then with the bias? This look, this single bar that catches a lot of people off guard. Because on this type of bars, we've had so many losses. On this type of bar, we create emotional memories from our trading, which is, play a trick on us of past transference. We are transferring from the past the emotion into the current chart. And because it becomes so emotionally driven to us, we switch our opinion and we say, oh yeah, this is such a bearish bar. It's bearish. The whole thing is bearish. Very unconscious way of analyzing the chart this way. So you have to understand even the way how you analyze the chart, because the mistakes are going to be there. And then obviously we're going to learn how to analyze properly. So don't go into the psychology of it, even though I'm talking a lot about this. In this class, the key is going to be repetition. Repetition of the correct sequence of the analysis, where we are making correct observations, enough observations for us to make correct deductions about the bias. Once the bias is defined, then we label. It's a spring. It's an upthrust action. It's a selling climax. It's an automatic rally and a secondary test. That's when we label. So even though labeling is such a crucial part of the Wyckoff method, and I usually start in WTC1 with labeling. Why? Because I need you guys to know the Wyckoff events and how the phases unfold. That's the only reason for us to start WTC1 class with labeling. There are no other reasons for that. But once you know the labeling, then we go deeply into the bias and into the analysis of the chart. Okay, let's see what else. Rami is asking, can you talk about the bearish spike volume in the middle top of the range? Let's look at that. Okay, so obviously we're talking about this bar right here. And I believe it's this bar, right? Okay, so we have, a mini structure right here. So here's our trading range. Definitely would define this as phase C, up thrust after distribution on the smaller structure. Buying climax, secondary test, attempt to upthrust that fails. And then a mini structure within the mini structure. Buying climax, automatic rally, secondary test, phase A, phase C. So what does this bar represent? It represents two events. One is buyers are trying to break out of the trading range, so demand is increasing. Step number one. Step number two, sellers are coming in and they're increasing the pressure on the buyers. Who won? Obviously sellers. Downward result is increasing, and that is suggestive of the reaction. And that's it. That's it. There's nothing else to that. Okay. Where are we? 510. Okay, so this is the type of the discussion that we will have each class, once we resume the bias game on Twitter. And I will most definitely do something for next week where we're discussing, bias game of some sort. Is this helpful, guys? Are you ready to work on this? Yeah? Okay, so each week, new bias game comes out, and you guys present your solutions without looking at the solution on the on Twitter. I want your solution because I'm going to be asking you to keep the score of your solutions. I want you to see your progress with that. I want you to identify the issues and the mistakes that you're making in the bias game, because if you're making mistakes with the bias game, your trading is most likely not going to be that great. So you need to feel comfortable with this. Okay, great. Okay, exercise number 2. So simulation. So this is something that we really enjoy as a class together, and I personally enjoy it as well. We just pick something, some kind of asset, and we just go bar by bar. Okay, I do not have a specific chart. I was just thinking that you guys are going to give me some kind of symbol, and we'll just go from there. So give me some kind of symbol. Do not give me any ETFs. Do not give me any small or mid caps. I only would like to see maybe large caps or something very, very familiar. Okay, so Moderna. Okay, great. Let's do Moderna. Okay. And the purpose of this exercise is not necessarily, not to know what's going to come, but to actually trade through and analyze each bar, right? So for instance, let me just see one more time which rally is better here. Okay. Yeah, let's go to the most recent rally. Okay, so okay. And we don't have to have the relative strength or moving average. Okay, here we go. So how much time do we have? We have like 15 minutes. So why don't I just do the analysis right here, and then we'll go from there. So we're starting with the buying climax, a clearly defined climactic volume and stop in action. Therefore, buying climax. And buying climax has a little bit of the range right here. So this is a distributional range, the causality of which suggests some kind of smaller effect into a change of behavior reaction, which we're going to call an automatic reaction. Next rally, secondary test. And please note that we are overcoming the resistance by a little bit. We don't have to do that at all. We could have failed at the low or high, but because of that, we are thinking that this is actually an element of strength. Also, an element of strength is the rally that we have had. The reactions are not that aggressive to the downside, so it's a bullish texture type of rally. We also should acknowledge that we are coming to the bottom of the climactic run to the previous support areas, which is also bullish. So at this point, we would be assuming reaccumulation to be confirmed or to fail. That's our goal. So the secondary test rally still suggests a reaccumulation. Volatility is increasing on the next reaction, but yet, what is not happening, guys, on the increased volatility? Volume is going down. I mean, it's saying, okay, what else? No follow through down. There is no result, right? So volatility increases, yet we're making a higher low. So therefore, the downward result is diminishing. And it's diminishing quite substantially. So why is that? There is some demand behind this. Okay, and then we have a mini structure right here with the small spring, and then the next rally. What does the next rally do? It comes to the same area of the resistance. It still does not have those big, violent reactions, which is still a bullish type of texture for the rally. So far, so good. Reaccumulation is being confirmed on each rally, on each reaction. Volatility increases again, and we would be comparing this now to, let's say, if this is reaction number 1, to number 3. So on the increased volatility for the reaction number 3, where downward effort is increasing, what kind of downward result do we have? Increasing or decreasing? Definitely decreasing, and decreasing more than the previous reaction or less? decreasing definitely more. So would we say that this reaction number 3 is more bullish than reaction number 2? Absolutely. So more bullish reaction. Okay. And we're in the middle of the range right here. We're stopping. So overall bias then, bullish or bearish? The bias is bullish. Okay, so now let's assume that we are in the position on the last bar right here. This is where we saw it. This is where we're coming in. Our stop loss is just below this reaction because this is where demand is coming in. So if the price goes there, then it should be supported. It also coincides with the local breakout right here, with the stop in action, breakout, breakdown, climactic action. So it's all kind of like very logical that, throughout this level of around 150, we have either supply or demand, having some kind of more aggressive stand. So this is a very logical place to be for the stop loss just below that level. Okay, with that, let's go bar by bar. Okay, healthy, bullish. Yeah, there is nothing here for us to, think about that this is any type of distribution or deterioration of the demand. The spread is increasing. We have the new commitment to the upside. We're intruding into this red bar really well, so we're still holding. Again, nothing here. Maybe just a slight diminishing spread on increased volume. Some supply is coming in. But we know that those two big red bars, they're going to produce some stop in action, some, supply presence. We are overcoming and committing now above this high right here. This is probably the most kind of like result aggressive bar to the downside that has both the increase of the supply and increase of the downward result. Plus, we're intruding into that initial selling bar. So still bullish. And most likely here we might break through. Why would I say that? Well, because look at the momentum characteristics. We had something similar here, but we are coming to this point after multiple attempts already to overcome it. So most likely, the more kind of like persistence we have to stay in the upper part of the range and just knocking on the door at some point, could get us through. Okay, some pause. And here is that breakout. Is this a good breakout or not a good breakout? We still will have to see what kind of test we're going to have, but the extension of this breakout is not that big. But don't forget that we have a very big trading range right here. We also have a little bit of the triangle, ascending triangle formation, which basically suggests that whatever demand is coming in, it's coming in at the higher price levels. Usually out of this type of the formations, we're going to have some kind of acceleration. We might not have a big backup action. Triangles usually do not have those big backing up actions. We might have just a small backup and then almost immediate continuation to the upside. And so far, this is extremely bullish. It kind of looks like this, but the difference is that we actually committed to the upside. And this looks more bullish than this, just because of that. Okay, continuation. Nothing is there. Alistair is saying, isn't that centered W a head and shoulder formation? Like this? Something like this? Or are you talking about like this whole formation, Alistair? Inverse head and shoulders, maybe. But we kind of not necessarily um, concerned about that at all. We are more paying attention to what the price and volume is doing. So let's just continue with that. There is some supply in the tails of the last two bars, but so far, I mean, like we're kind of expecting like a small reaction as a small backup action, just because we have a triangle here. And it's just so strong, doesn't give us anything. So, which is so wonderful. I wish we would be in this stock all the time. Even more so, okay, now we could talk about overextension above the resistance. Look at how much distance we are covering on this breakout. It takes several bars, for sure, but within these several bars, all of the reactions are only on the intraday basis. They're hidden from us. And I mean, this is a pretty significant move. This is a pretty significant overextension, and we're seeing increased demand character. Still bullish. There is nothing to this. Let me cover the buying climax bar so that we would see the volume signature better. Okay, here we go. So here is our first significant supply bar. We saw the supply in this supply tail. We also saw supply in the volume signatures. So as supply comes in, we're thinking there should be some kind of reaction to this. So here's the reaction. What could we say about this reaction, guys? Weak, muted, bullish, demand tail. Demand is trying to hold. Okay, yeah. So some demand behind it. No commitment. It stayed in the top half of the previous bar. Yes. 50% of that bar. Yes. Very bullish. Can't close below one half of the prior bar. Yeah. So still bullish. And we might have some kind of test of this supply. So it's possible that we might have more of the red bars, but overall, it's still bullish. In the context of the latest rally, it's still pretty much bullish. Okay. So we're holding here. Remember, we said that the backup action is not going to be that significant. We'll study the characteristics of the apex formations, so you'll have that. And I would say that this could be that backup action. There is really nothing else. Demand is coming in. Demand is coming in. And we are not going below this bar. If we don't, this is going to be a very, very strong move, and especially after the increase of the momentum of the low here. Okay. Okay. So a possibility of a spring, local spring for this trading range. Would you be considering buying this bar? What do you guys think? I would probably consider that. Why? Yeah, and Francis saying a bit too much volume. Yeah, for sure. Yeah, there is some volume. There is a gap action, but the recovery is really good. I mean, like it's kind of like a sprint up of the recovery. If we entered here on this bar, our stop loss is still somewhere here, or at the break even. We would be expecting that the worst case scenario we're going to come to about 190. And I'm thinking that it's actually a spot to add to the position. I mean, we still could have some testing action. We still even could have slightly lower prices, but we also could have a recovery here. So let's add, and let's just kind of deal and trade manage this. Okay. A test. Okay, so a test that is failing, but selling is not that aggressive. So I think that we're still okay. And I would be even adding at this bar as well. And we are in this cluster. Yeah, I think this is also a really good bar to add. So let's do one more. And we'll talk about, the scaling in, scaling out. So usually, I would be saying that, don't go into the position full sized. Unless you have a high conviction and maybe you are late, so you're just trying to create this size very quickly. I would probably be thinking about the approach that we're doing right now. Scaling number one, scaling number two, scaling number three, and then as we're going to recover, we could have some kind of fourth scaling. So let's see. Okay, I like that. Francis saying sellers still seem to be in control in this little reaction. I don't see the aggression, Franz. I mean, compare this to this with the latest reaction. Which one is more bullish? Adding on weakness is a bad plan. Wait for the strength from Steven. Not necessarily, Steven. I mean, like I've been actually kind of changing my trading style a little bit, or maybe like not even changing the trading style, but maybe more of diversifying my trading strategies where not only would I come in on the first emergence of the strength, but I also would come in on the weakness in a very strong market. This is an extremely strong market where you know that the price could run away really quickly from you. So I'm thinking here that we are in the backup action, and I want to make sure that we are actually getting our scale ins to the full size position. And usually I would have maybe like 4 to 5 scale ins to the full size. So if your full size, let's say 2% of risk for the overall equity, you divide that 2% into 4 parts or 5 parts. And then you take 50 basis points and you say, okay, I'm at 50 here. I'm at 100 here. I'm at 150. So maybe one more. And you could add that last one on the elements of strength. How would it look like? Something like this. So you could add the last 50 basis points right here. And your stop loss still, catastrophic stop loss will be somewhere here around this bar. You could have some stop loss around this area right here, just slightly below the breakout. So, okay, let's just see what happens next. Okay, another test. Okay, so here is our last scale in right here. And here is what we have. So on average, you are gonna, and we probably should have been scaling in more here. The second scale in should have been somewhere here, right around this breakout. So let's just say that we have 1, 2, 3, 4, and 5. So let's just say 250 basis points. Okay, something like that. And for now, I would just hold. I would just see, could we go and create a couple of things? Could we break out? Or if we're still in the trading range, could we go up, create higher high, and then retest at the lower level and then continue up? But because we had, again, a triangle compression, usually expansion is going to be fast. So I would be just expecting that maybe just, just a continuation and that's it. Okay, let me see what comes next. And we're at 5:30, so we're gonna finish soon. Okay, so here we are. So that compression resolves itself in a quick expansion like this. I think it was good that we were adding to the position on the way down. Okay, some supply is coming in, so we're still in the trading range. Not necessarily the best bar, but not the best looking bar. But in terms of the result, what did it achieve? Did it commit below the level that needs to be committed? No, we're just springing here and then we're coming back. So in that regard, demand is there. Somebody's picking it up. Okay, so here is our resurrection bar. So right away, confirmation of that bearish look looks bearish but acts bullish. That's kind of like the phrase that we coined in the practicum. Okay, attempt to overcome the resistance, so an upthrust probe. Let's see if we're going to recover right away or if we're going to react. So here's that almost immediate recovery, and I like it. I like that the volume signature diminishes on the recovery and on the close above the last bar. And this is the highest close. Obscure bar, but such a nuanced bar right here. Okay, we have this stride for the uptrend, so the next target is going to be somewhere here. At this point, I'm going to go a little bit faster. So here's that breakout. So again, the backing up action after the compression is never going to be extended, and it's never going to be deep, just because supply has been controlled within the trading range. And we know that it was controlled because of the higher lows, subsequent sequential higher lows. Okay. Significant bar breakout, test is positive, still strong, so still would be holding. Okay, now goes into the body of that significant bar, but still closing very favorably above the close of that significant bar. I would be even adding here. There is no reason not to, because we're still expecting the continuation. So this would be the add-on number 6. Yeah, uncomfortable reaction into the body of this bar. So now we're thinking, could we have possibly some kind of upslope like this? Could we go down, sprint below the low of this bar, and then go up here? If this is the case, this would be a good add-on right here. Okay, yeah, and that's exactly what happens. So here's that stride. And we're sprinting the low of this significant bar right here. So on the intraday basis, you would be buying on the way up throughout the whole day. Let's just say that we have add-on number 7 here. Okay, another good bar. Attempt to sell and then recovery right away into the close of the previous bar. Another good bar I would be adding here, so that would be an add-on number 8. Test, which is okay. Add here, number 9. And here we go. That's it. So we've overcome this structure. And we're seeing that this structure, again, as the previous big structure, is somewhat strong, right? So first of all, there is no big emergence of selling, and whatever is emerging as selling does not produce a big result. Next reaction also is diminishing. Selling that is coming in almost instantly being negated. So all of the bullish signs and such a big recovery and quick recovery. So we're like, what, 9 units in or something like that? And nicely done in terms of kind of scaling in bar by bar after each reaction. And one might be thinking, okay, well, we have a lot of supply here. what would we be comparing this bar to? Something like this. Obviously, different contexts, so we can't really, compare those two. But in terms of the look, gap, volume signature, effort behind it, somewhat the same. And I would say that the second instance is much more bullish, so still suggesting continuation, even if we have some kind of reaction into the gap. Okay, even better. Franz is saying scale back. Franz, I'm thinking that I would not be actually scaling back. Why? Because we just started the move where the cause is so big. And we've just experienced a sign of strength in the backup action. So I'm not sure that this is a good place to scale out. I think it's a good place to stay, as we're just at the beginning of this move. The cause is too big, so we have to stay for a longer duration here. Okay, why don't we do this? We are at 5:37. This is going to be it for today's class. I kind of got back into the practical mode, so thank you guys for that. I'm looking forward to the second week. So for those of you who are already signed up, don't forget you have homework to do. Here it is. These two articles will be uploaded to the class page, so please read those, and we will discuss both of them for maybe like 10 minutes at the beginning of the next class. And then we'll talk more about the bias game and then the anatomy of the trade assignment in the next class as well. For those of you who are guests and you guys are thinking like, okay, well, I'm WTC1 alumni, should I be taking this class? I think this particular session should be enough for you to consider properly, whether you will be signing up or not. The key here that I want to say is transition from knowledge to skill. That's what this class is about. And then for those of you guys who are completely new to Wyckoff Analytics, completely new to this whole WTC 1 and 2 courses and so on and so forth, I would suggest watch the on our YouTube channel, which is called Wyckoff Trading Method, yesterday's open door session from WTC1 class, and then think about the sequence of knowledge and skill building that we have in those two classes, and make your decision. If you have any questions, email us at wyckoff@gmail.com. Either Nancy or I will attend to those emails. And with that, great participation today, great start of the class, guys, really liking it. So let's keep it up like this, right? So interactivity with each other, questions, answers, and lots and lots of exercises and repetitions. I'm going to give you a really, really unique material on the significant bars, and hopefully we'll add to the body of knowledge as we go through those significant bar exercises. So that's going to be great. With that, thank you so much, and until next week. Bye-bye.